The Ponzi Scheme, named after con artist Charles Ponzi, is an investment fraud that pays profits to earlier investors using funds from more recent investors. The mechanism was simple. In the 1920s, Ponzi promised investors a 50% profit within 45 days by claiming to trade in international postal reply coupons. While a few early investors were paid, the profits were just a recycle of new investor money. The fallout was immense. When the scheme collapsed, thousands of victims lost everything. It's estimated investors lost $20 million in 1920s money, the equivalent of over $300 million today. Many were working-class immigrants who had given Ponzi their entire life savings and were left with nothing.
The Madoff Scandal. The Madoff Scandal was a Ponzi scheme, but on an unprecedented scale, active for at least 2 decades. The mechanism was a split-strike conversion strategy, a complex-sounding but entirely fictional trading model. Bernie Madoff, a high-profile Wall Street figure, used his reputation to build a fortress of trust, producing fake trading statements for his clients. The devastation was catastrophic. The fraud was exposed at $64.8 billion. Victims included charities, universities, and thousands of retirees who believed they had millions in the bank. They discovered their accounts were empty. Families were bankrupted overnight. At least 2 victims are known to have died by suicide after losing their entire fortunes.
The Enron Scandal. The Enron Scandal was a systematic accounting fraud that concealed billions in debt while fabricating profits at what was once America's 7th largest corporation. The mechanism involved special-purpose entities and mark-to-market accounting tricks. Enron executives created offshore shell companies to hide debt while reporting imaginary earnings from energy contracts that hadn't generated actual revenue. Auditors signed off on statements they knew were false. The human cost was staggering. When Enron declared bankruptcy in 2001, more than 20,000 employees lost their jobs within weeks. Their 401k retirement accounts, heavily loaded with Enron stock that executives had encouraged them to buy, became worthless overnight. Workers who had accumulated over $1 million for retirement watched it vanish to zero. Some were days away from retiring. They had to find new jobs in their 60s. Shareholders across the country lost $74 billion as the stock price collapsed from $90 to pennies.
The Theranos Deception. The Theranos Deception was a biotech fraud built entirely on technology that did not work, claiming to revolutionize blood testing with a single finger prick. The mechanism was elaborate theater. Elizabeth Holmes demonstrated machines that were either malfunctioning or secretly running conventional tests. When Theranos partnered with Walgreens and Safeway, employees would run samples on traditional equipment, then report them as Theranos results. Anyone who raised internal concerns was threatened with lawsuits and forced out. The damage spread in every direction. Investors poured in over $600 million that evaporated completely. Walgreens lost $140 million on the partnership and had to invalidate tens of thousands of patient test results. Safeway spent $350 million renovating stores for Theranos wellness centers that never opened, a financial blow that contributed to the company's eventual sale. Real people received false medical results. Some got unnecessary treatments for conditions they didn't have. Others missed diagnoses for conditions they did have.
The FTX Implosion. The FTX Implosion was a cryptocurrency exchange collapse that exposed billions in stolen customer funds, masked by Super Bowl ads and celebrity partnerships. The mechanism was direct theft. Sam Bankman-Fried secretly funneled customer deposits from FTX to his personal trading firm, Alameda Research. He used those billions for venture capital bets, political contributions, and Bahamas real estate. When crypto markets declined and Alameda faced margin calls, the customer money wasn't there. The collapse happened in days. In November 2022, customers tried to withdraw funds and discovered FTX was insolvent. Over $8 billion in customer deposits had disappeared. Life savings were gone. One man had deposited $2 million he needed for cancer treatment and couldn't access $1 of it. college funds, down payments for houses, retirement accounts, all locked in worthless FTX accounts. The bankruptcy showed FTX held just $900 million in actual assets against $9 billion owed to customers.
Gregor MacGregor and the Poyais scheme. The Poyais scheme was a 19th century fraud in which a Scottish con artist invented an entire country and sold land rights to would-be settlers. The mechanism was pure fiction. In 1822, Gregor MacGregor declared himself cacique of Poyais, prince of a prosperous territory in Central America. He created elaborate guidebooks describing a capital city with paved streets, an opera house, and a cathedral. He printed currency. He drew detailed maps. He sold land certificates and government bonds. He appointed a Poyais consul in London. None of it existed. The death toll was horrific. In 1823, ships carrying 270 Scottish and English settlers arrived at the coordinates for Poyais. They found only uninhabited swampland and jungle. No roads, no towns, no infrastructure. With no shelter and rampant disease, approximately 180 people died in the first months. Families had sold homes and businesses in Britain to afford the voyage. The survivors were eventually rescued and returned to England with nothing. Investors who bought Poyais bonds lost everything. MacGregor faced no jail time and later attempted an identical scheme in France.
The South Sea Bubble. The South Sea Bubble was an early 18th century market manipulation scheme that engineered a speculative frenzy and collapsed the British economy. The mechanism combined government backing with insider fraud. The South Sea Company offered to assume Britain's national debt in exchange for exclusive trading rights to Spanish South America. Directors bribed politicians, spread false rumors of gold mines and riches, and used insider information to inflate the stock price over 1,000%. They sold their own shares at the peak while encouraging the public to keep buying. The wreckage cut across all of British society. When the bubble burst in September 1720, thousands were financially destroyed. The middle class was wiped out. Aristocratic families lost ancestral estates. Isaac Newton himself lost £20,000, roughly $3 million in today's money, later saying he could calculate the motions of the heavenly bodies, but not the madness of people. Banks failed. Multiple investors died by suicide. The crash triggered a nationwide economic crisis and parliamentary hearings. Several company directors were imprisoned and had their estates confiscated.
The Wirecard Scandal.
The Wirecard Scandal was a German payment processing fraud involving $1.9 billion in cash that simply never existed, concealed through forged documents and complicit auditors. The mechanism was phantom revenue. Wirecard claimed to process billions in payments through third-party partners in Asia. These partnerships were largely fictional. Executives created fake bank statements, forged confirmation letters, and coordinated with external conspirators to deceive auditors. For years, they reported massive profits from business that wasn't happening. The implosion was absolute. In June 2020, auditors finally admitted that $1.9 billion on Wirecard's balance sheet could not be located. The company's market value of $24 billion disappeared within a week. Wirecard declared insolvency days later. Individual shareholders lost everything they'd invested. Institutional funds that held Wirecard as a blue-chip German tech success were decimated. The scandal forced Germany to remove Wirecard from its DAX index and overhaul financial oversight. German regulators had spent years defending Wirecard and attacking the journalists who questioned it.
The Bre-X mining scandal.
The Bre-X mining scandal was a Canadian gold mining fraud that fabricated evidence of the world's largest gold deposit through systematic sample contamination. The mechanism was called salting. Chief geologist Michael de Guzman would take drill core samples from a remote Indonesian site called Busong, then crush gold from jewelry and other sources and mix it into the samples. For years, Bre-X announced increasingly spectacular assay results, eventually claiming a deposit of over 200 million ounces of gold, worth more than $70 billion. Major mining companies competed to acquire them. The aftermath destroyed Canadian investors. At its March 1997 peak, Bre-X had a market capitalization of $6 billion Canadian dollars.
When independent testing revealed there was no significant gold at Busong, the stock became worthless in hours. Retail investors who'd bet retirement funds on the biggest gold discovery in history lost it all. Pension funds that invested hundreds of millions of dollars were gutted. Michael de Guzman fell from a helicopter over the Indonesian jungle 4 days before the fraud was confirmed, though his body was too decomposed to identify with certainty. The collapse erased over $3 billion in market value and forced major mining disclosure laws in Canada.